In this video, I'm going to talk about wage garnishments. So basically, what a wage garnishment is it's an order, usually a legal order through the courts, that basically seeks repayment of some type of debt that an employee has. And so the employer is going to get a garnishment order saying, hey, one of your employees owes this amount of money, and there's a court order saying that you are going to have to deduct amounts from their paycheck and pay them into basically the creditors. Okay, so so basically what happens is you get a garnishment order, and you have to somehow confirm, yes, I received this and I'm going to obey it, I'm going to comply. And what I usually do is I also kind of pull the employee aside by ourselves, and I say, hey, I just want to let you know I got this garnishment order. I'm going to have to start deducting amounts from your paycheck unless you get this situated and fixed. And so that way I kind of put the ball back in their court. They know that it's going to come out. And I just say, I have to hear from the company, not from you, that the garnishment is over. So if you get it all squared away, then great, I'll probably hear from the company and I won't have to garnish any wages. But until then, I've got to comply with this order. So these are the different types of garnishments you might get. Bankruptcy, and that has the highest priority over all other kind of garnishments. You could get a federal tax levy garnishment, meaning that an employee hasn't paid their federal taxes, and so they need basically the IRS has levied, has sent you a garnishment for monies to pay off their federal tax amounts that are due. Child support. So basically federal tax levies and child support have the same priority. It's basically whichever one you get first is the one that you're going to garnish wages for first. It could be a creditor like a bank, or it could be a creditor like a credit card company, student loans, and federal administrative wage garnishments. And what federal administrative wage garnishments are basically if an employee has been getting some type of Social Security payments, maybe disability payments, something like that. If so, then if they have been overpaid in the past but never paid back the overpayment, the federal government will actually send you a garnishment for any amounts that were overpaid that were never paid back. So that's what a federal administrative wage garnishment is. Okay. So this is just a little bit about child support. The Family Support Act requires immediate withholding for child support payments, and an employer can withhold a certain fee for administrating those child support payments. And a lot of states now require that child support payments be made electronically rather than by check. Okay, so I'm kind of focusing on child support here, but really all of the garnishments have a certain maximum amount of what we call disposable earnings, okay, that can be garnished. Okay, so for child support, the amount is 50 to 65%. Okay. And so again, that's 50 to 65% of disposable earnings. Okay, so not whole gross pay, just disposable earnings. So basically what disposable earnings are is you calculate that by taking gross pay, and then you subtract out your normal taxes like federal income tax. You're going to take out state income tax. You're going to take out OASDI. You're going to take out HI. You're going to take out any SUTA that the employee has to pay, and any like disability payments, like disability insurance kind of things. And that's going to give you your disposable earnings. Okay, DI. All right. So basically, so child support, they can garnish 50 to 65%. If you look back at this slide, federal tax levy is different, so I'm going to go over that next. A creditor is usually 25% of disposable earnings. Student loans and federal administrative wage garnishments are usually 15%. Okay, so that's how much, that's the max that they can garnish from your disposable earnings. All right, so we're going to talk about federal tax levies next. Not quite yet. So let's go over this example here, and this has to do with a credit card debt. Okay, so Kaylin O'Brien earned $730 this week. The deductions from her pay were as follows. So we've got FIT, OASDI, HI, state income tax, state disability insurance, health insurance premiums, credit union contributions, and United Fund contributions. So and then it says O'Brien's employer just received a garnishment order for credit card debt of $3,500 against her pay. Compute the following. So the first thing we need to do is compute O'Brien's disposable earnings. So of course for that we start with her gross pay, which is $730, and then we're going to subtract out certain taxes that we can for to calculate disposable earnings. So FIT, yes, we'll subtract that out. OASDI, yes. HI, yes. State income tax, yes. State disability insurance, yes. Health insurance premiums, no, that does not get deducted out. Credit union contributions, that's like a savings kind of thing, an elective savings, that does not get subtracted out for disposable earnings. And also United Fund contributions, that's like a charitable contribution, that does not get subtracted out. So what we'll do is, if you add up all of your checks up there that do get subtracted out, you should get a total of $176.96, and so therefore our disposable earnings are $553.04. Okay, so now we need to figure out the amount of her pay subject to the garnishment. So since this is credit card debt, okay, we said that for credit card debt we can take 25%. Okay, so that's what this is. So if we go back to our calculation, we'll just take the amount of her disposable earnings, which is $553.04, and we'll multiply that by 25%. And so the amount that you can garnish per week here, because she gets paid weekly, is $138.26. Okay, so that's how you would calculate the garnishment. And a lot of times the garnishment orders are going to tell you a certain amount to garnish, but you might want to make sure that your employee is being treated fairly, and so you might want to calculate what the garnishment should be, or what it could be, the max amount. This is the max amount that could be garnished, and make sure that they are not trying to garnish more wages than what they should. Okay, so let's go back and talk about federal tax levies a little bit. So federal tax levies, of course, take second priority after wages withheld for child support if the child support garnishment was received prior to the tax levy. And of course, levies are suspended if the debtor declares bankruptcy. So that's always happens. Bankruptcy trumps all else. Okay. So federal tax levies, you don't really use disposable earnings. Okay. Instead, what you do is you take out certain amounts that the government thinks are exempt, basically, when you're trying to figure out what you can garnish. So the amounts that they think are exempt are a standard deduction. So this is basically stuff from your tax return. So if you're single in 2013, it would be $6,100, and if you're married in 2013, it would be $12,200. And then you can also take your personal exemptions, which are $3,900 per personal exemption in 2013. You get a personal exemption for yourself, your spouse, and any dependents that you have. Okay, so let's look and see how this works. So Carson Holiday has a federal tax levy of $4,119.90 against him. If Holiday is married and has 3 personal exemptions and had a take-home pay of $1,020 this week, how much would his employer take from his pay to satisfy part of the tax levy? So note that these amounts, okay, the standard deduction amounts and the personal exemptions, those are yearly amounts. So we would have to convert those to a weekly amount for this problem. So let's take the standard deduction. If he's married, a standard deduction is $12,200, and then we'll take his personal exemptions. He gets how many? 3. So 3 times 3,900, and that's going to be 11,700. So this is basically what the amount per year that the federal tax levy can't touch. Okay? So that means of his total annual salary, $23,900 can't be touched by the federal tax levy. Let's figure out what that would be on a weekly level, since that's how often he's paid. So $23,900 divided by 52 weeks would be $459.62. So therefore, that's what the government cannot touch. So therefore, this week, if he has gross pay of $1020 this week, we're going to subtract out the $459.62 and come up with $560.38. So that's the amount that the government could garnish every week. So it wouldn't take too long to pay off that $4,119.90 if they decided to garnish all of that. And again, they might not decide, the garnishment order might not be for this amount, but this is the amount that they can legally garnish. Okay? And so that's all about wage garnishments.